A week that was supposed to be dominated by NVIDIA, overshadowed once again by inflation and the Fed. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Alex Stahl. Let's not forget, no one's here anymore.
Yep.
Thank you, one person, for watching. Mom, Dad, I love you. All right, let's get checking where markets stand here. Volume is super light. I'm over-exaggerating, but still, S&P is up by about 0.6%. Most of the major indices are in the green. I wanted to point out the Magnificent Seven. It was a bumpy week on certain moments for some of these stocks, despite that record high for NVIDIA this week. And now, overall, big tech still leading the charge. Deckers Outdoor, though, not to be forgotten, at a record high after they had pretty good sales in some of its departments like UGG brands. Who knew that was still a thing? And I want to point out Bitcoin up by 2%. Romaine, yesterday we got that Ether ETF approval, and that obviously been helping the entire crypto sector.
Yeah, as we wrap up the week here, we talk about a 6 week of gains for U.S. equities within reach. Of course, that's barring any major sell-off over the next hour. But Bank of America strategist Michael Hartnett says the rally is actually at risk of overheating. With the NASDAQ right now on the precipice of overbought conditions, the S&P not far behind. Hartnett, who was broadly bearish on stocks back in 2023 and so far this year, has been broadly neutral. Well, he says both his so-called global breadth rule actually shows equity indexes approaching levels that, in his view, would trigger a contrarian sell signal. Now, we should point out that Hartnett really might be the outlier on that front, as a lot more strategists really start to raise their price targets. And the latest EPFR global data showing major asset classes, all of them recording inflows in the week. Now, while it might be an overstatement to call this completely risk on, after all, 9 of the 11 S&P sectors are in the red over this 5-day stretch, there still is a tinge of enthusiasm coursing through this market. You see that in emerging nation stocks logging their first inflows in 3 weeks. You see that in high-yield bonds recording their biggest 3-week cumulative inflow since November. You see that in the pullback in precious metals. You see that in crude oil and the geopolitical premium being priced out. And it should be noted that this tinge of risk-taking had very little to do with NVIDIA this week, despite all the hype, or the path of the Ether ETF approval. But rather, it was that continued focus by investors on macroeconomic conditions and perceptions of said conditions. We got another data point on that perception front this morning with an update of the University of Michigan Consumer Sentiment Index, Alex, which showed people tempering their inflation expectations.
Yeah, it could have been worse, and the first read was worse. This was a tiny bit better. And those inflation expectations really directly linked in an inverse way to sentiment. So the orange line that you're looking at is the one-year inflation expectations in the University of Michigan sentiment, and then the white line is University of Michigan sentiment. And I just wanted to point out over the last 4 years is that as you have prices up and expectations up, the sentiment index winds up falling. Once you have prices kind of moving lower and the expectation moving lower, you wind up having sort of University of Michigan sentiment tick back up. And that leads us to where we are now. So this final read shows that people expect one-year inflation expectations to jump 3.3% versus 3.5% on the first read. So, okay, a little bit better. And you can see overall sentiment also improving just a touch, but it's still at a 6-month low. So it really begs the question, Romaine, to me at least, are we at something like peak Goldilocks? And kind of where do we then go from here?
Yeah, let's kick things off here to the close with George Maris, Chief Investment Officer and Global Head of Equities over at Principal Asset Management. And George, there's been a lot of talk here about some of the economic data we've gotten. I'm not sure if it really changed the narrative, but it certainly seemed to inject a little bit more optimism into this market over the past week. Are you buying into that?
No, I do. I think the issue is, again, as you just mentioned, peak Goldilocks. Things are really good, and we're seeing earnings continue to be strong. We're seeing them broaden out. We're seeing risk appetites looking more broadly. Do I think that there's going to be some retrenchment in terms of where capital is? Could we have some short-term normalization? Sure, but right now the setup is awfully good for equity markets.
Is the inflation story, is that kind of not the story anymore, George, or should we still be focused on it?
I think the inflation story became not the story when we went from an anticipated 6 cuts to 1-ish now, and we're worried whether there's going to be a July or September cut. I think that's been off the table, right? I think there's more of a concern of, is inflation going to be sticky longer term? That's the opening question. I don't think that the inflation part is really what's going to drive markets, from a true fundamental perspective for a while.
So what drives it, George?
Honestly, I think it's earnings. I'm thinking it's a broadening of earnings. Last year, you saw very strong earnings concentrated in a small handful of companies. This year, you're seeing earnings broaden out across the variety of sectors, with the exception of really energy. you've got strong earnings across the rest of the S&P sectors. I think that breadth is going to help drive markets going forward. And I also think you're going to see it broaden out internationally as well. It's not going to be just U.S. driven. You'll see it broaden out globally.
Before we get to globally, though, when we broaden out here in the U.S., where in particular are we talking about value? Are we talking about small caps? Are we talking about a rotation within the broader S&P?
Yeah, I think, look, again, we're still going to have strength with the Magnificent Seven, and tech and communications will still be good. NVIDIA's earnings, just the latest touch point with respect to that. But you're also seeing, strength in industrials. You're seeing strength in financials, and I think that'll continue to persist. So, again, does that imply that former laggards will catch up, like value, like small caps? For sure.
So when you look at some of the crowding then, George, that we've seen in the equity space, and the idea that, at least in theory, it appears that you're seeing more investors, particularly on the asset management side, the institutional side, looking for something outside the normal parameters of big tech and some of the other, I guess, tried and true names that have taken this rally to where it is. Where do you find that value, so to speak?
So one is within the U.S. or within kind of sectors. Look, I think the commodity and mining space is a very attractive area. And again, a lot of these names have run a little bit this year, but I think there's a lot more to go. And part of the reason there is they're huge beneficiaries, one, of increased infrastructure spend globally, and then moreover, long-term supply shortages that can't get rectified anytime soon. And so it really does set up for a perfect storm positively for that space. And I think folks will go that way. Secondarily is getting outside the U.S. a little bit. Again, the U.S. is still a great engine of innovation, but a lot of that has already been reflected in equity markets. I think you're seeing a lot of opportunity outside the United States in places where we haven't trafficked before, like the UK and even China.
The UK, really? What's the thesis behind that?
So the UK, less from a domestic perspective, more from an international perspective. The UK is home to many multinational companies, think pharmaceuticals, think industrials, and defense companies and things like that, that have got footprints that are very similar to, let's say, US multinationals, yet same footprints, similar revenue generation, and trade at a substantial discount to their US counterparts, primarily because of a UK discount. And you're starting to see more and more UK firms look to and actively relist in the U.S. and trade up much higher as a consequence. That's an arbitrage that has to be closed, and I think that helps support an investment case in the UK.
Also, George, that really pairs with your commodities, because it's a lot of commodities and oil companies and raw material companies that really help that FTSE 100. Where else globally do you feel like makes the most sense? And then how do you pair that with what we're seeing in the FX market?
Yeah, so two things. One, and they're very much kind of a yin and the yang here, right? So one will be Japan. Japan has been strong for the last year plus. We've seen tremendous returns again this year, nearly 30% year to date on the topics. Again, a strong year last year, but you're really coming out of 30 years of a bear market, seeing significant corporate reform, restructuring, positive shareholder moves, and still relatively low valuations in a lot of sectors, especially domestic sectors. And they're benefiting from a very weak yen as well. So earnings power will continue to grow, especially in local currency terms. So Japan continues to be a very attractive place to invest. And then kind of on the opposite side is China, whereas you've had this tremendous momentum in Japan for the last, again, year and a half. You've kind of had the antithesis of that in China, where it's really been a very weak market. You've had 3 consecutive years of negative performance there. I think that's gone way too far. It's now the cheapest market in the world. And while we're doing a lot of on and nearshoring in the West, particularly the U.S., that also creates a lot of on and nearshoring opportunities for Chinese companies as well. And again, given where the sentiment is, which is so overwhelmingly negative, it does set up some really interesting long-term opportunities.
George, when you're making your portfolio allocation and stuff, how much do you look at what fiscal spend is in whatever country you're working in?
So you have to pay attention to the macro environment. I'm not smart enough to be able to predict where the macro economy is going. I can't predict the weather. I can't predict the macro, but we are paying attention to certainly what's happening in macro land and whether or not you're going to see stimulative policy, i.e. not only just fiscal spend, but also easy monetary policy. And it's easier to invest in a market where there's going to be more liquidity, i.e. easier fiscal and monetary than when there's not. So clearly a factor that comes into play.
All right, George, always great talking to you. Have a wonderful holiday weekend. George Maris, Chief Investment Officer and Global Head of Equities at Principal Asset Management, helping us kick us off to the close here on this Friday afternoon. When we come back, details on the hot rate trading strategy that has been gaining some traction since Fed Chair Jay Powell signaled rate cuts may not happen as quickly as some investors were anticipating.
All right, plus we're going to talk with Fred Thiel. He's the CEO of Marathon Digital Holdings. His insight on the company's renewable energy deal with Kenya.
And we're going to talk with an analyst who says the sell-off in Lululemon, it's a bit overdone. The company, the worst performer in the S&P 500 index so far this year. That analyst, though, says that could change in a big way. That's coming up in just a bit, right here on The Close on Bloomberg.
Season is here.
This is a get out the popcorn moment.
And across the board, just pummeling of expectations.
Earnings matter. That's really clear.
Bloomberg is first to break the numbers.
Hey, folks, we've got Microsoft.
Apple earnings crossing the wire.
Alphabet, wow, coming in way above expectations.
Hertz driving in the opposite direction.
A lot still to come.
With the smartest insights.
Meta's kind of damned if they do and damned if they don't.
Is this their iPhone moment?
I view this as Operation Kick the Can to August.
Continuing coverage on Bloomberg. Context changes everything.
Friday afternoon before Memorial Day weekend. What do? We're going to talk about carry trade, because why not? We got exploiting differences in interest rates is set to become one of the most popular investment strategies in the coming months. And that's according to strategists across Wall Street who are touting these carry trades. Now, it involves borrowing in a low interest rate currency and investing the proceeds in a different currency that offers a higher interest rate. So for more on that, we want to bring in Bloomberg's Elena Vizcaino. Elena, where are we seeing all the carried trades right now within the market? Usually dollar yen is like what we all go to, right?
Yeah, and usually for emerging markets, people also do dollar yen, and they've been very popular for the last 2 years. As you know, emerging market central banks raised interest rates very early on and very aggressively. But now we're seeing it play out in the G10 space, right? And that's essentially because traders are expecting subdued volatility for the coming months. First of all, Jay Powell came into the market earlier this month and basically ruled out rate hikes going forward. And second of all, we're about to enter the summer period, right? People are off their desks, they kind of de-risk their portfolios. So it should be the perfect environment for carry trades.
Well, that's what I'm curious about. I mean, so the volatility is a big component, or the lack of volatility is
Yes.
a big component of it, or more stability, I should say here. But how far out are they making bets right now? Is this sort of like a short-term thing, or are they really committed to this maybe through this year and into next?
Well, I think the commitment for now is through the summer, right?
Yeah.
I mean, in the story that we wrote, kind of Bank of America, UBS, et cetera, are kind of touting to the summer lull. Central banks are also around the world in other developed markets are kind of taking cues from Jay Powell, right? Mm-hmm. So they're also not going to rush out to cut interest rates this year. Inflation's still sticky. Growth is making a sort of comeback. So their hands are tied.
What kind of crosses, like carry trades, are the most popular right now? Where are we really seeing it?
Well, people are touting to the Australian dollar, betting for the Australian dollar and against the Swiss franc to take advantage of the interest rate differential there. And within emerging markets, people like places like Brazil and Mexico, where, you know, interest rates are like 10, 11%, and they can't really cut until the Fed gives them a cue, right? They're tight.
Is there any sense, though, when you talk to these people, that they are confident that the Fed is going to give them that cue? Because it's one thing to say, okay, volatility is tamped down, we're heading this summer, but there's still a lot of unresolved issues when it comes to the Fed and, more importantly, what they plan to do or what they were going to telegraph to do here. So is that not a concern?
Not for them.
Yeah.
They're putting out their bets. They're sticking to their guns when it comes to you know, their carry trades, and at least for now, they don't see anything on the horizon that can derail that. Now, I started working here in 2020, so I've seen the pandemic, I've seen wars.
Yeah.
So bearing a black swan event,
and they do happen, clearly.
Yes.
Yeah, so there's that.
Well, the good thing, Maria, that means it can only get better for you from here. So, all right, Elena Vizcaino there, a closer look here at the resurgence of the carry trade, a popular trade. Of course, it kind of fell out of favor when the Fed was, I guess, you know, moving fast and breaking things. But I guess now things are a little more stable. So why not?
Yeah, and especially even if we see some kind of policy change, for example, over in Japan, like the differential will still be so wide that even if they wind up, say, hiking a little bit or doing a currency intervention a little bit, it's certainly not going to make up for the rate that we have here in the U.S.
Yeah, absolutely here. All right, something to keep an eye on. We're also going to be keeping an eye on Lululemon. We're going to be joined after the break by Tom Nikic over at Wedbush. He's going to discuss, well, why that sell-off that we've seen in that stock might be overdone. That's coming up next, right here on The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we're going to start with NXP Semiconductors, getting a raise to buy from neutral. This over at Mizuho, and a price target going up to $325 all the way from $265. The analyst saying that after a few years of underperformance, analog chip makers writ large are seeing improving fundamentals that analyst says will last through the second half of the year. Shares of NXP up about 1.5% on the day. Next up, let's take a look at BJ's Wholesale Club, with the shares today extending to record highs after UBS raised its price target on the retailer to a street high $97 a share, up from $89. The analyst citing BJ's continued outperformance on membership as well as tangible progress in general merchandise shares. Those shares up about 6% on the day. And finally, Deckers, the company behind Hoka, UGG, and Teva, getting several price target hikes following an incredible upbeat earnings report. Stifel raising its price target to $825 from $775, though the analyst reiterating a hold rating there. The analyst saying he was impressed by the execution in the most recent quarter, but still remains concerned about durability of the multiple if growth does start to slow. Nevertheless, investors pleased with what they saw, pushing Deckers shares higher by more than 13%. And those are some of our top calls. Now, we do want to stay in the sell side space and stay in the apparel space and take a closer look at Lululemon, because today officially it became the worst performer in the S&P 500 on a year-to-date basis. Quite a turnaround for a company that for the last few years has usually been at the top of the heap when it comes to outperformance. But our next guest says, well, a turnaround could be afoot. Tom Nikic joining us right now, Senior Vice President of Equity Research at Wedbush Securities. And just give us a sort of, I guess, the bull case, because I guess there is no bear case anymore, Tom. I mean, what is the bull case that would actually turn this stock around?
Well, first off, thanks for having me on the show. The bull case on Lululemon would be that, this is a brand that has a great track record of success, has a great track record of product innovation. They'll benefit from the secular and structural trend towards casualization of dress. And when you look more company specific, they have big growth opportunities internationally, where they're underpenetrated at only 20% of sales, and also with men, where again they're only about 20 to 25% of sales. So. All in, we've seen a big sell-off in shares year to date, and we think everything will be fine here, and we think that this could prove to be a buying opportunity.
Well, I am curious, though. Tom, one of the reasons why we saw the sell-off, it wasn't just about the numbers. I think there was a general sentiment, and it may be wrong sentiment, but there was certainly a general sentiment that it doesn't have the same cachet in terms of the brand itself and the brand image. There was also a lot of concern, too, that the company has now started to discount in ways that it didn't do in the past here. Are those things that also can be fixed?
Look, I think on the discounting front, we've actually seen it. So we track the discounting on the company's website. And we've actually seen in the last 2 months a reduction in the number of items that are discounted. In the most recent checks we did, the number of items on sale on Lulu's website was down double digits year over year. So we think that they're still maintaining that full price premium brand positioning. And then on the brand cachet front, the thing that a lot of people have been scared of is competition here. And there's been some new competitors in the space. Allo and Viore are the ones that investors have been very focused on. Look, I've followed this company a really long time. You've always heard about competitors that were going to come and derail Lululemon's growth trajectory, whether it was Outdoor Voices or Athleta or Sweaty Betty. There was always somebody out there that investors were nervous about. We're gonna derail the growth trajectory here, and Lulu has just kept plugging along. So I would expect that they'd be able to fight off these current competitive threats just as effectively as they have in the past.
Tom, you also talk about the hyper growth internationally helping to mitigate slower growth at home. Can you talk about what that hyper growth internationally looks like?
Yeah, so last quarter and last year, they grew their international business in constant currency terms between 55 and 60%. That growth was primarily driven by China. So in China, the brand grew over 80% year over year in the fourth quarter. And this has been a brand that historically has been very North America focused. The vast majority of their revenues have historically been done in North America. But obviously, it's a global industry. A lot of the industry giants have very big operations outside of North America. Nike, for example, does a bigger international business than they do in North America. So at just 20% of sales, we think Lululemon's international business is still quite small today and has a very long runway for growth.
Hey Tom, how long until you think we kind of stabilize here for Lululemon and see some material grind higher? Then what's the time frame?
I mean, we'll see, and they're going to report earnings in about 2 weeks here. The last call was a little bit downbeat, given some macro-driven slowdowns that they've seen domestically quarter to date at the time of their report. So our hope would be that when they report in 2 weeks, they'll be able to strike a more optimistic tone and say that they've started to correct, some of the issues that they had earlier this year, and essentially, give hope to the market that things are progressing in the right direction. So that would be my hope. And given how much the shares have traded off this year, I think a little bit of positivity would go a long way.
Yeah. All right, Tom, thanks a lot. We really appreciate it. Tom Nikic, Senior Vice President of Equity Research over at Wedbush Securities. Just the tricky part, Romain, is kind of where we are when it comes to the actual economy and how much people are willing to spend on other stuff.
Yeah, particularly overpriced tights.
Hey, some people like them. Not my jam. I shop on sale.
If you're going to cut back on anything.
That is for sure where I'm cutting back. All right, coming up, we're going to be joined by Marathon CEO Fred Thiel about the company's energy deal in Kenya.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Alex Steele. So we're almost done with May. We have one more week to go. But you look at the best performing sectors in the S&P so far this month.
Yeah.
Tech, communication services, and then what am I going to say?
It's got to be utilities.
It's got to be utilities. Yeah. And it's the power company. It's like we can easily say utilities like the Duke Energies or something that actually give you the power, but the power providers are the ones doing really well.
Yeah, because I was always wondering about this. I was always taught to hate the energy, the utility companies.
Right.
But apparently I should have been investing in them all along.
I know.
Who knew?
Like, are they growth or are they safety or is it a combination? I sort of debated this with Gina Martin Adams on radio the other day. She disagreed with me. But anyway, and it would be a growth sector because of all the data centers and AI build out, which kind of leads us to our next conversation. Marathon Digital Holdings is a digital asset technology company, and it's entered into an agreement with the Kenya's Ministry of Energy to support the use of energy and optimize renewable energy projects across the country. Marathon CEO Fred Thiel joins us now for more on this news. Fred, when I read the news, I read it a couple times, and I'm like, wait a second. Why is a digital asset technology company investing in energy projects in Kenya? Can you help me understand the link here?
Sure. So one of the things that companies like ourselves do is we have the ability to consume energy that otherwise would be essentially wasted or stranded. You have a lot of renewable energy projects which typically can't sell all the energy they produce, so they have excess energy. We can be a base load customer, locate our equipment at site where it's generated, and consume energy. So if you think about how solar farms, wind farms, hydroelectric systems are built, they're selling energy into the grid depending on demand. And if demand is lower than the max production capacity, they are essentially losing revenues. And so we can go in there and soak up any excess energy. The difference between what we do and what the AI industry does is we can turn our systems on and off depending upon demand. The AI industry needs to consume energy all the time. So they are a base load demand customer, whereas we're what's called curtailable. So in the case of Kenya, we can go in and work with the government. We're essentially forming a committee where we're going to evaluate all of the different energy resources they have, look at which ones are ideal for doing digital asset compute, and then we will go and build data centers at those sites, consume that energy, which provides additional revenues to the power utilities, which means the country now has more revenues to invest in infrastructure, but more importantly, it allows them to provide electricity to their consumers at lower cost over time.
Ah, that's so interesting because you're right. We don't often think of it like that. It's more like we just blame you guys for being a power generator suck at the end of the day. But in essence, you're saying that you can turn on and off and be flexible. So kind of in yourself be an own mini grid to then help the larger grid manage its own power load. Is that fair?
Exactly. And that's what we do, for example, in Texas and other places, actually 11 sites on 3 continents around the world.
So where's next, Fred? I mean, obviously, this seems to be part of a broader strategy here. I assume Kenya is not the end of it.
No, Kenya is the first country in Africa. It has one of the most developed economies, great rule of law, great government structure, and obviously great relationships with technology companies. So we're starting in Kenya. We already have a big presence in the Gulf region where we have a large facility that we did in partnership with the sovereign in UAE. And other countries like Tanzania, there are opportunities in Nigeria, there are opportunities across Africa for power. And then Asia is another area where we're going as well. Mm-hmm. We also do something very different in that we can do what's called energy harvesting. We can take energy, for example, in the form of methane flare. We can take methane from landfills, which is something we do in the U.S., and we can take biomass and create energy from it, so create our own energy, and then we can consume it. And here's an interesting thing. Industry today spends 50% of their energy bill to generate heat. And of that, about 14% is what's called low-grade heat. So think about if you're either making methanol or ethanol, a lot of industrial processes, they need heat. So what do? They use electricity to heat. Right. We can generate electricity from a waste product. We generate heat using our data centers, and that heat can be fed right back into their systems as a closed-loop process. No need to use grid energy for that. So we're actually supplementing energy in that way, and it's a way for us to create our own energy.
Well, can you talk a little bit more about your business specifically, and rather, I guess, broaden it out to just crypto mining overall, because it is energy intensive, and obviously this seems to be a big part of your strategy to lessen the impact here. But are the energy needs of mining in this environment right now, have they increased?
So a couple of dynamics happen. In the past 2 years, for example, the energy efficiency of mining equipment has increased to the point where our energy load on a per terahash, which is kind of like saying horsepower in a way for our industry. So what it takes for us to generate a certain amount of compute, the energy needed to do that has dropped by 30 to 40% over the past 3 years. And so we become more and more energy efficient. And the reason why is we have this event called a halving that happens every 4 years. Right. So we are obliged to lower our operating costs or else we go out of business. So we're driven to become more and more energy efficient. We're driven to go find lower and lower cost energy that's more stranded. We're kind of like the energy customer of last resort. Whereas the AI industry can afford to pay 8, 9, 10 cents a kilowatt hour, we're looking for energy that's 1.5, 2 cents a kilowatt hour. So it's a very different profile, and this is energy that otherwise is typically wasted. And essentially electrons that just don't make it to the consumer.
Are you in competition? I mean, you keep bringing up the AI folks, obviously another energy intensive industry. Are you in competition with those folks right now? I mean, obviously not in terms of what you're selling, but in terms of energy needs and how you deploy it.
Yeah, so if you look at the traditional Bitcoin mining industry, these are large sites, 100, 200 megawatts of power being consumed, typically on grid, very much like a large data center. And that competes directly with the AI industry. What we're doing with our energy harvesting business is essentially going after power the AI industry can't use.
Yeah.
It's either too remote, there's no internet connection, it's too sporadic, it's intermittent, and they don't have the ability to shut down systems and curtail when the grid needs it. And so we're able to find pockets of energy in different places, and that's one of the reasons we're moving a lot of our focus to the international markets, because there are opportunities there where the AI industry really can't go. So I think while we do compete at utility scale, we're specifically, Marathon that is focused on really identifying those pockets where we don't compete with the AI industry and where we actually can be supplemental to the grid.
All right, Fred, got to leave it there. Great to catch up with you. Fred Thiel there, the CEO over at Marathon Digital, fresh off of inking that deal with the Kenyan government on those energy needs. Obviously a very energy intensive industry, what he's doing. And I know he brings up AI, which is probably consuming way more energy than the crypto miners, but certainly something that they have to figure out.
Yeah, and the crypto mining industry has been trying to get this message out, I think, for a little bit, to be like, we're not sucking all the power demand. We can help get power back to the grid. We can turn stuff off when there's an overload. They're trying to get that message out in a big way, as AI centers need more and more power at the end of the day.
Yeah, but for them, it's not really going to be the message. It's got to show up in the actual numbers and the usage. And at least here in the U.S., we've seen some of those numbers. And they are astronomical.
Yeah. And the grid is dicey as it is.
But maybe this is a good first step here, and maybe it'll lead to something better. Meanwhile, we keep our eyes here on some of the big individual movers in the market on this day, and one of the biggest is Workday, having an awful day. The share is down as much as 15%. It's our stock of the hour. We'll explain the big move when we come back after the break. This is The Close on Bloomberg. All right, time now for our stock of the hour. Closer look at Workday, the software application maker, having its worst day going back to 2016 after cutting its full year forecast for subscription revenue, and said customers are being more cautious with orders. Bree Bradham joining us right now, a Bloomberg reporter who covers stocks for us. And I am curious about this. When they start to talk about customers pulling back, now we're talking about companies, corporations, right?
Yeah.
I mean, this is primarily workplace software.
Yeah.
And they're saying they're seeing softness there?
Yeah, absolutely. So when you're thinking about, who would be spending on this, you're looking at businesses who are looking to use their software to interact with their employees and stuff. But when you have to think about where companies are going to spend their money on tech right now, it's probably not necessarily in that area. Everyone's chasing AI growth. So that's kind of maybe where the spending is heading.
They're not going to spend money to communicate with their employees, is what you're saying. Actually, that might be a good thing.
Or not to upgrade it, maybe. But are these small, medium-sized businesses, or are these larger businesses that are usually Workday's customers?
I think it's pretty much across the board, right?
Okay.
Working with a lot of different customers there. But I mean, this gets to the broader themes that we're seeing across the stock market. When we think about where growth is focused right now, if we look at tech today, like Workday is the worst performer in the NASDAQ 100 right now. Like Romain said, down about 16%, worst day since 2016, but the second worst performers into it. So another software company. When we think about the broader week, obviously the big story this week was NVIDIA. They do obviously have that AI story, and they added something like $217 billion in market cap yesterday.
Well, that's what I'm curious. I mean, Workday is kind of an interesting bookend to the week because it is kind of a tale of two cities. I mean, tech is still the best performer this week.
Yeah.
But there are a lot of names that are getting left out of that list that are still in the red. You mentioned two of them with Workday and Intuit here. Yeah. Is this because the companies that are lagging don't really have an AI story to spin?
That definitely feels like the message of the week, right? It's like when we look at the tape today, when we look at the tape yesterday, it's AI or not. So that does seem like the story that we're seeing this week.
What is going to be the next catalyst then for tech? Like we got through NVIDIA, that happened. So now what?
Yeah, well, that's a great question. We're kind of moving past earnings season. NVIDIA was the last big kind of question to see whether or not we could propel, earnings growth going forward. So now we're getting through that. It seems like we're limping through the end of the week on that. So we'll see where it goes from here. NVIDIA obviously has this big, highly touted stock split coming up. We'll see how much that kind of brings interest back in. But
when you saw the earnings that we got out of NVIDIA and some of the optimism around this idea, because the whole narrative, and I don't know if you were the one who wrote it, but there was a great story in the terminal that kind of talked about this kind of ratified the longer term narrative for AI. But it also meant that folks were now starting to look more broadly for other tech names that aren't NVIDIA or aren't Microsoft or Alphabet that could provide an AI play.
That's a great question. We had a really great story, like you said, about kind of when you're broadening out that look. There's an interesting name that was doing really well today, Vistra. It's a utility. It's up, when I looked earlier, about 10%. That's one that some of my colleagues wrote, is getting caught up in this broader AI wave. They obviously aren't directly involved, but they're a power company that's involved from that end. So it's not just your NVIDIA names.
Yes, I've been saying that. I totally believe in that. Constellation Energy, too, one of the best performing stocks in the S&P so far this year. Hey, Bree, thanks a lot. Really appreciate it. Bloomberg's Bree Badham joining us there. But I have to wonder, Romain, NVIDIA does show the numbers, right? But what about the derivative plays? Like, what kind of numbers do the power providers or utilities or whatever have to show to justify the run-up that we've seen, or are they showing it?
Well, they haven't shown them yet. I mean, maybe in the next couple quarters it'll start to show up. I think it's going to even get broader than that. I mean, and I thought the story was great because it really kind of went across the board, the push into software, the push into utilities. And then the idea, too, that you have to look at who the end user is going to be all this. Is this going to boost Dell and its servers? Is it going to boost PC makers? So there's a lot here, but it's going to take time, to say the least.
I think we get Dell next week, don't we? Is that true? We get Dell earnings next week?
Maybe, yeah.
Yes, we do get Dell earnings. That would be quite interesting to see that outlook as well. All right, we're going to count you down to the closing bells. We got 10 minutes to go. Lori Calvasina, head of U.S. Equity Strategy over at RBC Capital Markets, joins us. This is Bloomberg.
This is the countdown to the close. Romain Bostic alongside Alex Steele. About 10 minutes until we get to those bells. Alex, actually ending the week on a relatively good note, despite some of the, ructions we had over the last 2 days.
Yep, although I gotta say, volume is so light today. I mean, I feel like everyone put in positions yesterday and then kissed the weekend goodbye. But yeah, the S&P is still looking for 5 straight weeks of gains. We're looking at the NASDAQ 100, same deal, same with the NASDAQ overall. We have the Dow just pretty much flat on the day. So sure, it's been a constructive week despite some volatility midweek.
Yeah, a constructive week here. Keep an eye on the S&P here, kind of sitting on the waterline right now when it comes to gains and losses on a weekly basis. So it looks like the NASDAQ is headed for a 6th straight week of gains. Lori Calvasina joining us right now, head of U.S. Equity Strategy at RBC Capital Markets, to help us count down to the closing bells. And Lori, I want to start off with investor sentiment. Because we've seen that really start to tick up over the last few weeks here, whether, I don't know, pick your measure that you want to do. But we've seen it go up. And I know it's kind of a loaded question to ask if it's justified, but I'm going to ask you whether it's justified.
So I think it depends on what's driving it, is the real question. And I think anytime there's any sort of, legitimate thing to price in, you can overdo anything, right? And so I would say at this point in time, what's bothering me, and I'm not bearish over a long stretch. I'm kind of neutral on the market this year. But I think that what really bothers me is that we've just seen the sentiment on the Fed just oscillating. It's like this pendulum that's just swinging very, very quickly back and forth. And if I think back to like March, there was all this rampant Fed fear, and the Fed is never going to be able to cut this year. They might have to hike. Inflation is sticky. The U.S. economy is too hot, and just real fear. And then we've gone all the way back. We had, sort of a baby pullback. We really didn't see sentiment collapse that much. You had 1 week where AAII net bulls turned negative. 1 week. Yeah. And then we just started climbing again, and people got all excited about the Fed. And I think what really bothered me is when I listened to that last Fed press conference, I heard no hikes. And then I was in the middle of talking to investors that week. I was out on the road, and the instantaneous conversation was, okay, well, now they're going to start to cut. Like, how did we get from no hikes to cuts? Like, those are different things.
Well, then that raises a question as to how much conviction there is behind the sentiment then, right? Because if people are expecting that, despite the fact the Fed has said you're not getting that, and maybe they change their mind in the next couple of meetings or so. But without that, I mean, how precipitous does that make those sentiment indicators?
Well, I think, what I'm seeing, right, is that we've started to see AAII creep back up. The last couple weeks, it's been around 17% net bulls. It was a little bit higher this week. And so we've just seen that optimism go right back to where it was in January, right back to where it was last summer, right before we had these pullbacks in the market. And you sort of look at it and say, can we absorb bad news? And that's really what those sentiment indicators tell you. Do you have the capacity in there to absorb bad news? And when those sentiment indicators are high, generally the answer is no. And I think that's why we can get knocked down, so quickly by a couple of bad inflation prints, for example, like we had in 1Q.
Then we get back up again really fast.
Right.
So what does that tell us in sort of how we construct, like what's going to outperform then going forward?
Well, I think, what we've also seen, right, is sort of the rotation trade has been caught up in all of this. And I'm an old small cap strategist, so we watched that pretty closely. And they bottomed out in mid-April relative to large, and then they started moving back up, and now they're moving back down. And they're really sort of emblematic of Fed bets, essentially, because you really need the cuts to get small caps to work. So when those cut optimism, when that's, moving up, small caps are doing well. When it's fading back, they're getting pushed back down. And the small caps are really interesting because they're holding the line. They're not making new relative lows, but they can't really break out either. And I think it just illustrates the narrow band that this sentiment is in. And frankly, we're focused on one issue right now. Like, can we please talk about something else at some point?
Please?
I don't think so.
But that brings a great question. Like, what is then the catalyst? Like, do we all just wait till September at this point?
Well, I think at this point, I was talking to investors this past week. I was out on the road. I've lost count of how many cities I was in. And
I thought we didn't do that anymore.
Yeah, I mean, we do. We do apparently in my job. But it was interesting because we were sort of talking about, kind of second half outlooks. And, when do we start to price in 2025, right? That's sort of an interesting conversation. It still feels a little bit too early. But it's interesting because I have investors, on the one hand telling me they're not going to trade the election. There's not a lot of differences between the candidates on economic and, kind of stock market related issues. There's not a lot to do. But then at the same time, I heard another investor say, well, it's really hard to have visibility on next year when we've got this big election coming up. And I was like, well, people are telling me it doesn't matter, yet you are telling me it matters. So I do think that we are waiting for the next thing to happen. That might be the election. That might be starting to debate the 2025 economy. But it feels a little bit early to have those debates just yet.
It does feel early, though. But at some point, you have to do that. And you kind of have to do it, I don't want to say soon, but you have to kind of, start kind of piecing it all together. And I guess based on the data that we already have, what we know to be true here, can you cobble together a picture, at least one that you would be confident in?
So look, I think if you look at kind of where we are in the cycle, right, and I kind of hate that question, but it comes up a lot, and it's been this massive point of confusion. I think you can go back to that and kind of go back to the drawing board to some extent. There's sort of tactical issues, which we talked about earlier, right, kind of like the Fed views, the sentiment. Those are really kind of short-term issues. But if you kind of zoom back, the thing that really seems to be resonating in a lot of my meetings with investors who have been frankly confused about the last year and a half is, are we in a recovery? Are we mid-cycle? Are we maybe a little bit early cycle? And my theory of the case is if you look back to 2022, the stock market, both small and large, fell similarly to what we see in a recession. UMISH sentiment went to recession lows. AAII net bulls went to GFC lows. If you looked at Russell 2000 PE, went to 11.3 times on June 16th of 2022. That's consistent with a recession low. I can come up with like 10 different indicators that looked and smelled like a recession, yet we did not call it a recession. People felt as bad as they typically do in a recession because of the inflation spike, but jobs were fine, so we didn't call it a recession. Maybe we should redefine our definition of what a recession is, and if you do that and say, okay, it was close enough to count as one, we've just been in this weird misunderstood recovery, then I think you can get some optimism when you look out over the next couple years and say, yeah, maybe we have to sort of, kind of stall around a little bit in here, digest, figure out the next story, but things are still generally kind of in the middle of an uptrend. That, I think, is, kind of thinking that's appealing to a lot of the clients I talk to lately.
There was a story that we had on Bloomberg about how rank and file voters right now actually believe we're in a recession right now, the majority of them, despite the fact we're clearly not. When you talk to investors who, in theory, should be at a somewhat higher level in terms of their knowledge of the economy, do they feel that way now?
So I will tell you what I heard this past week was, and I was in a lot of cities where there was a lot of construction going on, and there was, sort of it was difficult to get around some of these cities, frankly, with the traffic because of all the construction. But generally, it sort of sounded what I've heard in some of the other opinion polls, which is that the local economy is perceived as actually being pretty strong in a lot of places. It's when people start thinking big picture and nationally that they get a little bit more dour on things.
Interesting. All right, Lori, we're going to have to leave it there. Always great to talk to you. Have a wonderful Memorial Day weekend.
Gold star in studio Memorial Day weekend Friday. Like,
Absolutely.
for sure, if that means anything.
I wouldn't be anywhere else. This is fun.
All right. Well, grab some ice cream on your way out, by the way. It's ice cream day here at Bloomberg World Headquarters. Lori Calvasina, head of U.S. equity strategy over at RBC Capital Markets, helping us count down to those closing bells. They're right around the corner. Stick with us as we go to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Thiel. We're counting you down to the closing bell. And here to help take us beyond the bell, it's our global simulcast with Scarlett Fu in the television studio, Tim Stenovic and Carol Massar in the radio booth, as we welcome our audiences across all of our Bloomberg platforms, as well as those folks watching us on YouTube. Carol, how are you?
I am well. It's Friday, a long weekend. It's gorgeous outside. What could go wrong?
We're inside, not outside.
That was weird.
Wow.
A lot of things, I guess.
We got another hour of the program. There's a lot that can go on between now and then. You know what I'm surprised about?
I'm surprised to be optimistic in some way, but it didn't come across.
There's some optimism in the markets today. I mean, look at the NASDAQ composite, up more than 1% right now. It turns out some people are at their desks trading today.
Or they just put in their orders and they left for the day. The data coming in from University of Michigan. Yeah, you can do that. Well, or you can let the robots take over. The UMich data came in better than expected, particularly with the inflation expectations moderating. So that gave a boost to those who are looking for, once again, the Fed to cut rates sometime this year.
Yeah, I have to say, I've struggled to find what's going to be the next direction for markets at this point. Like, I know we have Jobs Friday, but that's not until June 7th. So what are we going to do in the next couple weeks? I realize there's some economic indicators next week, second quarter read of GDP, for example. We also have PCE. But really, guys, come on. Like, what's
I'm counting down to the blackout period.
Yeah, we know. The blackout with no Fed talks doesn't mean the grid's going down.
I don't see the countdown clock's not on screen yet.
All right. Well, we're almost there, Tim Stenovic here. I mean, it's kind of interesting, too, the complexion, because we came into this week with the big expectation this would be a big week for tech. And I guess technically it was. That is the leading sector on a weekly basis. But we should point out the majority of the sectors on a weekly basis are in the red. As for the day, you actually got some green across the screen despite the oscillations that we've had all day. The Dow Jones Industrial Average right now straddling the line between gains and losses. It's up about 4 points right now, but of course it takes a while for these numbers to settle. They're still going to be down on a weekly basis. The S&P 500 up about 37 points or 0.7%. That's only going to again give it to about break even on a weekly basis, but the NASDAQ composite doing what it does best, up 185 points or more than 1% on the day, up on the week as well, while the Russell 2000 is going to close out the day higher by 21 points or 1%.
All right, that's the small caps. Back to the big caps I go. S&P 500, definitely a positive tilt to the index. 355 names, Scarlett, actually gaining some ground today. 147 to the downside and 1 unchanged.
All right, let's look at the sectors. And no surprise there, given the numbers you just detailed, that you have a lot of green there. Communication services and tech, the biggest sectors in the S&P 500. They've each gained 1%. The NASDAQ 100, NASDAQ composite closing at record highs. Utilities also right up there, gaining almost 1%. We'll talk about that a little bit later in the next hour, but it goes back to what Alex Stahl was saying about how they are driving and they're benefiting, I should say, from the demand for power to fuel all these AI data centers. Healthcare, REITs, and energy are the laggards on the day.
Data centers, energy, right? The new AI play. All right, let's get to some of the individual gainers, if I may. Ross Stores, we were breaking down the earnings yesterday after the closing bell. At its highs, up about 10% today, finishing the day with just shy of an 8% gain. Discount retailer boosted its EPS forecast for the year. The company reported first quarter results, as well as we've mentioned, with analysts noting that comp sales were roughly in line with expectations. This was your number 1 gainer in the NASDAQ 100, number 4 gainer in the S&P 500. All right, another retailer, BJ's Wholesale, finishing just shy of its highs of the session, but still up almost 6% for the Friday trade. Analysts raising their price target since the company reported earnings on May 23rd. It reported yesterday before the open, but the momentum, I should say, to the upside, kind of continuing into today's session. The retailer reported adjusted earnings per share, revenue, and membership fee income for the first quarter that topped analysts' expectations. UBS raising the price target on it to a street high of $97 a share from $89, and the stock finishing at $88 and change today. And then another one, we've all seen the commercials. I'm assuming we've all seen them. Guardant Health rallying after the company's Shield blood test to screen for colorectal cancer received the backing of an FDA advisory panel This stock up at its highs about 17%, but still a really respectable gain, up more than 13% for the Friday trade.
I don't think I have seen those commercials.
You haven't seen them?
But now apparently
it's like the little block, the box, the blue and white box that just tells you like a different way to test.
No, but thanks for saying that.
You're welcome.
All right, I want to go to some of the decliners. In the S&P 500, had my eye on what happened to Intuit today, down more than 8%. This after the company reported losing 1 million customers who use its TurboTax software for free. That highlighted concerns about demand for the company's software. Shares fell more than 8% today. 10 million people used TurboTax for free this year to file their taxes. It's about a drop of 1 million from a year ago. Also, Workday shares dropping the most in more than, going all the way back to 2016 at this point. This after the company cut its full-year forecast for subscription revenue and said customers were being more cautious with orders. Shares today fell by more than 15%. And then Summit Therapeutics lost nearly a quarter of its value today. This after the company reported data from a trial of a lung cancer drug with partner Akeso. That data was seen as disappointing. I should note the data abstract of the drug was released by the American Society of Clinical Oncology. It's only the worst day going back to February, so it's been a pretty volatile stock. Back then, just a few months ago, it fell 26%. Akeso shares, for its part, fell by a record, Alex, in Hong Kong after the abstract release.
All right, well, the Treasury market closed at 2 p.m. today. However, let's just check in on it anyway. So we saw the 2-year yield close up by about 1 basis point, and then you had a touch of buying in the back end. But honestly, not a lot of movement. But I found a catalyst, you guys. Thank you, Barry Knapp. I being me, next week, $183 billion worth of Treasury auctions. We get a 2, a 5, and a 7.
Ooh.
In fact, you get a 5 and a 2, about $70 billion of each. So maybe that could be a catalyst, particularly as the 2-year yield kind of sits right near that 5% level.
All right, I have no easy segue off of that one, so I'm just going to go for it. This is a great story that caught our attention by our Crystal C. It's about the TikTok video playing and going on about the finance bro stereotype, and it's gone viral. Megan Boney, she is the girl on the couch, in case you haven't heard of her. She posted at the end of April, and basically she was singing about looking for a man in finance, and her video has amassed more than 2 million views, but there's been a meme off of it, and so everybody's been having some fun with it.
Romaine and I know this because a few weeks ago we went to the Brooklyn Mirage together, and it was a rave.
Really? And you guys danced to this?
Yeah, we were just dancing to this.
Is there video proof of this?
We were just dancing to this all night long.
Were you guys singing along? I'm looking for a man in finance, plus fun, 6'5", blue eyes.
And I've been getting all these weird phone calls ever since. I don't know why.
I'm pretty gullible, so for a hot second, I believe that was true.
You wish it was true.
I was in bed by 9, whatever night I'm talking about.
But the best thing about this is that, so she put that out on TikTok, and then everyone else kind of like built on it, right? Liquidity made it into electronica mix, and then everyone else added their thing to it. They changed the lyrics around a little bit. I mean, I still like the original lyrics, but go have fun with it.
The original lyrics, you're not down with the remix.
No, she's not. So literally, I sit across from Scarlett, and she's been kind of jamming to this all day. So
I've been singing it all day. Yes. I got all the other producers involved as well. It's true.
You're not looking, Scarlett, are you?
Well, I don't like the blue eyes. Everything else I'm on board with.
So here's another story, guys, that I feel like we need to talk about. Fruit Loops apparently is going to keep their artificially brightened colors. Some Pop-Tarts, though, you guys, are going to lose them.
Whoa, that is so bright.
That is bright, and that is a lot. So apparently, the snack company Calanova that makes Pop-Tarts and Rice Krispie Treats is working to replace artificial additives in some of its products with natural alternatives after the dye in them was banned by one state. Can we have Fruit Loops that are boring? Oh my goodness.
Yeah, I'm not on board with this. I mean, look at that. That looks delicious.
I mean,
you know what this made me think about too was, you remember those college students that a couple years ago did a study and found out that all the Fruit Loops are actually the same flavor?
Oh, that sounds about right.
Yeah, they basically said it's all just a ruse. They're different colors, but they're actually the exact
same. They all look like Gatorade, basically.
Yeah.
But yeah, you just put enough sugar in it, it's going to taste the same.
Did you read down on the story? Breakfast cereal maker Kellogg is keeping the dyes because they haven't yet run afoul of new legal restrictions, even though the company found a way to do these without these colorings for essentially the same product.
I don't know.
The artificial, the dyes, all this stuff, it's makes me a little nervous.
I'm sorry. Also, if you're eating Fruit Loops for breakfast, I think the dyes are the least of your concern here. Maybe it's like the 1,000 grams of sugar.
Good thing those GLP-1 drugs are curing pretty much everything.
I'm just saying.
I will say, after a state like California bans some of these things.
Then again, someone in my household.
I think we know the direction that other states are going to go. I wouldn't be surprised if we started to see more bans across the country.
Well, where California goes, so goes the nation. as it's often said. But, the idea that they're going to tone down the colors, you've got 10-year-old boys who that's why they wake up. Because they want bright red Fruit Loops.
Wait, are you speaking from experience?
Maybe.
All right. Well, I hope you have Fruit Loops if you want them, or Danish rounds, or what have you, or
no
not.
Thanks. No thanks. Move
We're
on.
looking for a man in finance.
Not doing that. All right. Have a good weekend, guys. A safe weekend, a good holiday weekend. That's our wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you again on Tuesday. Have a good weekend, everybody.
All right, well, our coverage on Bloomberg Television does continue after the break. A sit down with the CEO of Okla, Jacob DeWitte, going to be joining us. A conversation up ahead here about nuclear power. This is Bloomberg.
I'm Scarlett Fu.
And I'm Romaine Bostic, closing out what has been a really wild week. A week, of course, that was dominated by those earnings out of NVIDIA. A week that everybody was really focused in on tech. But at the end of the week, the attention actually shifted back to the macro and back to inflation data. The net effect of it all, though, we continue to see stocks rise, both on a daily basis and for some of the indices on a weekly basis. The S&P closed higher by about 0.7% on the day, though flatline on the week. The Nasdaq, though, did its best to show why it is what it is. There was a lot of activity in the crypto space, particularly, though, with Bitcoin. The big Ether rally that was supposed to happen after that approval didn't quite materialize. And then take a look at the 2-year yield here. While the yield picture didn't change a whole lot, there was a lot of volatility in between. That could change in a couple of weeks when we get the big Fed meeting. Now, that second line of your screen, that's a lot of the software companies out there, Scarlett. We talk about NVIDIA and how they had a great day, a great week, we should say. But some of the software companies, I don't know what's going on. They didn't do well at all.
Not so good.
Yeah.
And one of the big cap software companies is Workday that we're taking a look at here, down 15% on the day, the biggest decliner in the NASDAQ 100. The enterprise software company cut its full year subscription revenue forecast, saying that customers were being a lot more scrupulous, a lot more cautious with their orders overall. And of course, that cast a pall over what it could say for the rest of the year. Meantime, Dell Technologies, a hardware company, climbing more than 4% on the day, gaining for a fourth straight day. And in fact, since NVIDIA reported its results, it's gained almost 10% alone. So this company reports earnings next Thursday, and ahead of those numbers, we're seeing analysts turn increasingly optimistic over its role as a supplier of AI servers. In fact, last quarter, Dell said that its backlog of AI servers reached $2.9 billion. So we're going to get an update on that over the next week. Now, speaking of AI, one market story that I've got my eye on this hour is utilities and how they've become a growth play on top of their traditional role as safe havens that pay rich dividends. In the past 3 months, the group has returned more than 16%. That is double the 8% gains in communication services and tech. You can chalk it up to the AI boom since AI data centers consume a lot of energy. Vistra and Constellation Energy are the biggest individual winners, with several hedge funds building or adding to their stakes in the companies last quarter.
Yeah, interesting, Scarlett, here how much this AI boom has really sort of put renewed attention on the need for clean energy. That has been growing by leaps and bounds. But what role will nuclear power play in our energy future? Jake DeWitte is joining us right now. He's the CEO of Okla, which is developing next-generation fission reactors. The company went public and trades on the New York Stock Exchange. Jake, great to have you here in studio.
Thank you for having me.
All right, so we should just add a caveat. You are basically a nuclear scientist. Scarlett and I are not. So we need you to talk to us like we're 5-year-olds here. Kind of explain the technology and exactly what it's going to do that's going to be better than the nuclear power that I think some of us of a certain age are more familiar with.
Yeah, I mean, at the heart of nuclear, it's so captivating because it's like science fiction, but real, right? When you split an atom, you produce like 50 million times more energy than when you combust a molecule of like a hydrocarbon. That's an insane increase in energy density. So what I'm excited about and what we're excited about at Okla is bringing forward these next generation technologies that combine different kinds of coolants and materials with a long history of development and proven record behind them, that allow you to take advantage of these kind of great characteristics of nuclear, the energy density, and a system that's kind of physics safe.
Yeah.
So you put the safety of the system on the side just by natural physics, natural phenomena, allows you to simplify the plant and have a system that can do phenomenal things, including recycling waste. So things that are sort of some of the challenges people have seen with nuclear, being big, expensive, you can change by being small, being affordable. being able to recycle waste.
Right.
It's very promising.
What about being safe? Because that's been a bug. One of the reasons why we really haven't built a lot of nuclear reactors in I don't know however many years here. But I came up of a certain age where nuclear reactors were a thing, nuclear power plants were a thing, and then they kind of fell out of favor, and then it just became everyone was just scared to do it.
Yeah.
Has that changed?
I think it is changing a lot for a couple factors. One, I think one thing that's fascinating is people have really started to dig in to understand the promise that nuclear has. And they realize that when you look at the data, it's actually one of, if not the safest source of energy we have that produces significant amounts of energy, and it's clean. It doesn't produce carbon or, warming emissions. That's a huge benefit. And people who are curious about how do we solve climate? How do we solve the energy transition? How do we power our future of when we look at this transformative technology of AI coming forward? They see the upside potential that nuclear has. And they dig into it, they learn, they get excited. But then these next generation systems build on that already great record by simplifying it, by just putting the physics of safety in its side. In other words, they become self-stabilizing. As they heat up, they shut themselves down. Natural forces do it. You don't need people. You don't need things like that. They keep themselves cool. Again, just natural phenomena like gravity, thermal expansion, convection. And it's been done before. It's not just theoretical. It's been done.
So going back to Romain's point about how the perception towards nuclear power has really shifted in the last couple of years, there was a Pew Research survey done last year that found 57% of Americans now support the use of more nuclear power. That's up from 43% in 2020. We know there's tremendous demand for affordable power, but is there specific demand for nuclear power, or are corporate customers and consumers kind of agnostic to what kind of power they want? Cheap power first.
Yeah, I think what we're finding is they want cheap and reliable power. That's what we're really seeing come to bear. And I think that combination really lends itself well to what nuclear can do. And then when you add on the clean attributes, it really rockets it up into sort of a unique product offering in the energy markets. So corporate customers get excited because you can have something that helps them meet their climate goals, provide reliable power that they can run a business 24/7 off of, and ultimately be very affordable. And I think that's what is actually very exciting right now about where nuclear is coming forward. And when you look at what an AI sort of application is, it's really energy 24/7 needed. They like it to be dense, compact. Mostly the appetite, because of the demand signals in AI, is to build these things close to where the data centers are going to be built to use the power from them. And nuclear is really kind of an ideal solution for a lot of that.
So you're planning on going public. Why now? What is it about the environment right now that lends itself to you're going public, or is this you need to raise money because of what you see in the next 3 months or 6 months?
Yeah, it's a great question. I mean, so we about a year and a half ago, we saw the opportunity set for our product and sort of the market starting to take off. And we knew that being public was a place the company would end up being because of the opportunities it opens for us on a number of fronts. And then it was about finding the right partnership and the right sort of timing. And we found that with the Alt-C SPAC vehicle, which we're very excited to partner with, successfully complete that merger 2 weeks ago. Hit near record low redemption rates, fully financed the business, which is great. It's a big equity financing event for the company. Now we're fully capitalized to go execute on our business model and scale. So it kind of enabled all of those things at the same time. The company itself is now structured where you have a lot of long-term shareholders, like my co-founder and I, and our major investors are all locked up over like a 3-year period. It's all about building the long-term value here. What we talk about at the company is, look, this is a technology set that can literally power the planet for 1 billion+ years using proven reserves and known technologies.
Yeah.
That's exciting.
So you've been in conversations, I assume, with some of the AI players, and obviously, we should point out Sam Altman, of course, who is the poster child for AI right now, the head of OpenAI, is on your board here. I mean, what are those conversations like?
I mean, it's been insane how that number of what they're expecting in terms of power needs has shifted the entire data center conversation kind of from where it was pre-AI to where it is now. People used to talk on the data center side, we'd hear customers talk about selling a couple megawatts at a time as kind of big sales. Now it feels like it's hundreds of megawatts to gigawatts. Wow. And they're so oversubscribed. It feels like all the power we can deliver, people will take, is what it kind of feels like, only for the AI side. And there's other markets too on top of that. And I think the AI use case is still evolving. I think we don't fully have an understanding of how AI, using AI, how it uses energy, how the user interface of AI is actually going to change the energy dynamics. Yeah. We have ideas of it. We know it uses more energy than typical search. So it's just creating this massive demand pull.
Well, Jake, this is really fascinating stuff, and I think we have to get you back on soon because we're going to be talking about this a lot for the months and years to come, I'm sure. Jacob DeWitte there, he is the CEO over at Okla, Scarlett. And, we've been banging this drum on energy usage when it comes to AI and all these data centers and everything else it's going to need, but we haven't had a lot of conversations about nuclear power.
No. And I mean, I think the Fukushima disaster cast a really long shadow over everyone. And it's been a while, but climate change has kind of changed people's minds and opened people's minds up to the possibility of going back to nuclear energy.
All right, a fascinating subject here. When we come back, we're going to make a bit of a pivot here, Scarlett, because when we return, we're going to take a look at the car rental company Hertz and one of the most audacious and profitable bets by investors on a post-bankruptcy revival. And here's a question for you before we go to break. It's an easy one. Equity investors usually get wiped out in bankruptcy proceedings, but Hertz shareholders, they were compensated. By how much?
Very little.
The answer when we come back. This is Bloomberg.
That's my guess.
One of the great markers of out-of-control, irrational market froth during the pandemic was when legions of day traders began snapping up shares of Hertz in the aftermath of its bankruptcy filing. That filing came 4 years ago yesterday, May 23rd, 2020, when the car rental company asked the judge for protection from creditors amid sweeping COVID travel restrictions that destroyed demand and left it holding the bag financially, since Hertz owned a large portion of its fleet outright instead of acquiring cars through buyback agreements with manufacturers. That combo led to a stunning fall from grace for the century-old company. But as we know now, that was far from the end of the story. While the shares of companies that file for bankruptcy reorganization usually sell off in anticipation that equity investors would be wiped out, something curious began to happen with Hertz. Traders piled into the stock with the belief that Hertz would not only survive, but that shareholder value of some sort would be preserved. It was a bizarre gamble, and it turned out to be an incredibly smart one. The stock price, which had plunged from more than $20 a share in February 2020 to 56 cents the first trading day after the filing began, to rebound immediately, tripling in barely a week. Daily trading volumes, they were more than 20 times historical averages, and while the share price did remain mired below $2 a share for months, that rocket ship really began to take off in May 2021. That was when Hertz struck a deal with Knighthead Capital and Soteris Management to buy the company out of Chapter 11. Now, it was a deal that gave the reorganized Hertz an enterprise value of more than $7 billion and gave stockholders a recovery of about $8 a share. And they nailed it. They really did. Bloomberg data showed that every single one of those equity holders paid no more than $6.25 for a stock that even Hertz had said at the time would be worthless. By July 2021, the stock resumed trading over the counter as a new issue, opening at $22 a share. By November, the stock moved to the main NASDAQ Global Select Market under the new ticker HTZ, again, a new issue, with local Florida pitchman Tom Brady tweeting, "To the moon." And the share price, that's exactly where it went, headed up to a peak of $35 a share. Now, to be sure, things aren't perfect at Hertz. It got embroiled in a bad press a couple years ago over those wrongful arrests of some of its customers. Sales still haven't yet returned to pre-pandemic levels, and it made a huge misstep in agreeing to buy those 100,000 Tesla EVs. But despite all of that, you add it all up together, and the Hertz post-bankruptcy story is still one of the most remarkable rebounds in recent market history.
Yeah, especially when you consider Hertz shares are trading right under $4.80 at the moment. Pretty remarkable. That was a great wrap up of what's been happening. And I can't believe that was only a couple of years ago as well. Well, speaking of EVs, Lucid announcing it'll eliminate about 400 jobs in the coming months. It is the latest move by an electric vehicle maker to cut costs as the market for plug-in cars slows down. Bloomberg's Detroit bureau chief David Welch joins us now. And David, Lucid is no Tesla. It's a relatively small player in the space, but it does have a backer with bottomless pockets. So it's interesting that it's taking this route of cutting costs.
That's right. Look, they have the Saudi Public Investment Fund as a major shareholder. And the Saudis are very interested in electric vehicles. They're very interested in the future of transportation and energy. The question here is, will they have patience forever? And EV sales they're still growing. They're just not doing great. Lucid, very small player, probably has very good technology, but they sell expensive vehicles that just they just can't move in big volume.
Yeah.
That makes it tougher to get scale, get your costs down, and get cash flow positive. And look at that cash. They ended last quarter with about $4 billion, close to it. But last year, they burned $3.4 billion. So you can see why they're cutting costs. If sales aren't going to get them to scale, they're nowhere near positive cash flow. And it's tough for these startup companies, most of which have already gone out of business. It's really Lucid and Rivian are the two that have real staying power so far. And even they're sort of struggling in this kind of market.
Well, but the relationship with the Saudis and the idea that Saudi Arabia has made it clear that they actually want to build manufacturing facilities down there on the coast, do you think that could be the lifeline? Does that buy them at least a little bit of a time, a little bit of a cushion?
It could buy them a very long period of time, a really big cushion. The Saudis have a lot of money. They can will this company into existence if they want to. But they're probably not going to do that forever. And Lucid does need to come up with less expensive vehicles, get them to market, and sell them in pretty good numbers to show that there's real progress and that eventually it can stand on its own.
All right, Bloomberg's David Welch, thank you so much joining us from Detroit. Have you ever rented a EV?
An EV, yeah.
Yeah?
Yeah,
How'd that go?
not intentionally. No, I just got there, and this was, during the pandemic when, they had no cars on the lot. So
Right.
whatever they gave you, you basically had to take. And it was a Tesla, it was fine. I was able to charge it.
You were able to charge it?
Yeah. I mean, it's on a Tesla charging now. I think if it was another, maybe not so lucky.
All right, when we come back, our top three movers and shakers of the day. This is The Close on Bloomberg.
All right, time now for our next up segment. This is where we highlight the entrepreneurs, the founders out there who are really moving the needle for our economy, our markets, and our technology. We talk a lot on this show about the innovative ways companies are making fashion more sustainable. More than 24 billion shoes are made every year, yet 1 in 5 go straight to the landfill. That's why Portland-based startup Hilos combines the process of 3D printing with the art of creating footwear. Joining us now to talk about it is one of the co-founders of that company, Elias Stahl. He's also the CEO of Hilos. Great to have you here on the program. There are sort of two components to this that I find fascinating. One is the idea of sort of getting what is effectively custom shoe wear, but also getting footwear that is sustainable by the very nature of what it does. What was the impetus behind the idea? Why did you create this company, Elias?
Well, and I'll add a third into there, and thanks for having me. It's great to be here. The third is how we can bring manufacturing back to the U.S. and how we can have manufacturing as a force, not just for urban development or advanced manufacturing, but to your point, making an industry that's classically very wasteful, slow, and inefficient, really a beacon for how we can see climate manufacturing and sustainable manufacturing coming back to the U.S.
One aspect of this, I wanted you to talk about the turnaround time as to how long it takes when you get orders, how long it takes to produce that batch of shoes, because whenever we would talk with particularly the retailers, the resellers out there, they would always talk about how much inventory they had to keep in stock on a day-to-day basis, whether they were brick and mortar or whether they were online. Does this address that problem as well?
Absolutely. I mean, the very crux of the problem is we've got a market that is fast, it's creative, it's driven by trends, and we have a supply chain that is built for a mass market that's no longer there. It's slow, it's wasteful, and it depends on overproduction. So right now, footwear brands are designing for spring, summer of 26. That takes about 12 to 18 months to launch a new line into market. And because this uses injection molding and tooling, there's a high upfront cost that needs to be amortized across high volume. So we've got a supply chain that depends on high volume and waste at the end of the day, waste that you and I are paying for and that the planet is paying for. This is an industry that is the fourth largest polluter on the planet, accounting for 10% of carbon and a quarter of global chemical use.
Which is remarkable when you sit back and think about it, because the payoff, I guess, for consumers is that you can go into a store and say, I like that pair of sneakers, and be able to walk out of the store with it. With these 3D printed shoes, will consumers be able to do that? Go into a store and say, I like that, but I want to change the color a little bit, and maybe I want a smaller heel. And can they walk out of the store with it?
So the focus for us with 3D printing, which is a powerful technology, 3D printing and generative design, allow for a speed and agility to take what's in your screen and bring it to the shelf. But we blend that with traditional methods of make so that you can have leathers and knits, you can have the variability of sandals, boots, sneakers, everything from luxury to technical, outdoor, and athletic. And you're able to make this faster turn. So 100 pairs into market, launched as quickly as 45 days. And you, the consumer, see The one striking focus you're going to see immediately different is everything's always in stock. You can have size runs that are much larger than normal. You can have more colorways. You can have designs that are on trend. Everything will be in stock because we're making locally without the traditional 6 to 9 months of manufacturing lead time. That model allows us to bring manufacturing back home.
Right.
Because traditionally footwear is very labor intensive.
Yeah.
But by creating 3D printed modular methods of make that blend traditional shoemaking with a far more sustainable and lower labor form of assembly, we're able to have manufacturing cells in every major city. They're able to have high craft, high touch assembly for your favorite brands. So Hilos is really an end-to-end product creation platform, allowing the biggest brands and retailers as well as independents that don't normally have access to this technology to move supply chains overseas to their backyard.
So Elias, let me ask you, which brands have you pitched? Which brands have been receptive to your pitch?
We're not able to disclose the brands that we're currently working with. What I am going to tell you is that in the next 18 months, you are going to see some of the leaders in fashion, in sports, in technical outdoor, and in retail, all launching significant lines with this technology. For us, this is a way for technology to elevate the craft and creativity of the industry and integrate in traditional supply chains by onshoring them.
I'm going to ask you, Elias, the Warren Buffett question, which is about your moat. What is the competition right now? And do you have enough proprietary technology where you can fend off any sort of imitators?
The biggest focus for us in our key moat is fundamental methods of make for manufacturing. So Hilos has patented new ways for shoes to come together that eliminate component parts and reduce labor. But then on top of that, when you create a completely new way of manufacturing that allows for speed and creative agility, but with new levels of comfort, design, and performance, you need the entire industry to be able to adopt that at the speed of digital. So the second layer to the Hilos stack is a completely generative design software platform that allows a designer to upload a 2D image, sketch, or even prompt, and will generate a watertight 3D file that we can sample and then manufacture for them launching directly into market. This we unveiled just a few weeks ago at Milan Design Week, and the response was stunning. We had people saying you're taking an entire 150 years of supply chain and condensing it into 2 minutes of creative expression.
Elias, I see a bunch of sneakers behind you there. Is there anything that cannot be made through 3D machines? I mean, there's sneakers there, obviously, but leather shoes, heels, sandals, anything, everything?
So 3D printing has one large limitation, but it also is an incredible strength. You can 3D print only with a number of materials, and we were the first to really commercialize TPU, which is a thermoplastic polyurethane, so an advanced polymer, for end-use production for footwear. But you're able to design that material any way you want. So we take what is traditionally 65 components assembled in 350 steps, and we print 5 parts assembled in 12 steps. Not all of those parts are printed. We integrate traditional leather, but it's the ability to make without tooling, without having to amortize, and with the speed of digital.
Got it. Elias, really appreciate your joining us today. Elias Stahl is co-founder and CEO of Hilos. Thank you so much.
Thanks so much for having me.
All right, let's go now to the top 3, where we name drop some of the people driving the day's most talked about stories. And first up is Boris Johnson, the former UK Prime Minister and, of course, champion of Brexit.
He's not running again, is he?
No, he's not. Yeah, that was a good question, though. He has been dropped from an ad by Irish sports betting company Paddy Power. According to the New York Times, the ad was supposed to feature Bojo wearing an England soccer jersey and saying, "I told you I would get us back in Europe," referring to both the upcoming Euro 24 Soccer Championship and the Paris Olympics. But the employees of Paddy Power in the UK did not appreciate that hypothetical ad or that prospective ad, and they didn't want to be promoting a divisive figure like Bojo.
Yeah, I found this hilarious. As a non-British person, I found this hilarious, and I think they should have ran the ad anyway, but I can understand why maybe some people within the contours of the UK might be
he was game.
A little sensitive about this still. But anyway, I mean, if you can't have fun with Boris Johnson, who can you have fun with? Back here in the U.S., somebody I'm keeping an eye on is Kristen Johnson. She's at the CFTC now, the Commodities Futures Trading Commission, as a commissioner on that board. But we're now learning, based on Bloomberg reporting, that she is the front runner to take over at the FDIC. Of course, Martin Gruenberg agreed to step down earlier this week following all those reports here about the culture that's going on at the FDIC, the main banking regulator here in the U.S. But Kirsten Johnson's name apparently at the top of the White House list as to who they want to replace him.
And the White House is under political pressure to find someone to fill that FDIC chair space, because without a replacement, the FDIC would be split between 2 Democrats and 2 Republicans in an election year.
Yeah. And how does she get approval?
Oh, yeah, the Senate has to approve it. Good luck.
Good luck.
That's all we need to say there. All right, the last person we're watching is Calvasina. She's actually the dog behind the Doge meme. Sadly, she has died after 14 years of internet fame, according to her owner. She was the age of 18, and of course, she became famous after her owner in 2010 shared a picture of her on her blog. The owner is a 62-year-old kindergarten teacher, and she became an internet meme, and shortly thereafter became the face of Dogecoin.
It's kind of funny too, because when I heard that she had died, I didn't really know the whole backstory as to like whose dog this was, how did it become famous, and I went down that whole rabbit hole here. And it's kind of funny. She kind of the owner took it all in stride, basically saying, hey, it's all fun and games here. But it's funny how one little expression that this dog made on one particular day ends up becoming the meme that takes over the world, and at least for a brief period in time, made a lot of people several $1 million.
Yes. Yeah. Do you know why it's called Dogecoin?
No, why?
Because the meme was to poke fun at how dogs can't spell. Yeah. So instead of Dogcoin, it was Dogecoin, like Doge. Yeah. Dogs can't spell, Romain.
Dogs can't speak either.
Well, some people think otherwise, but.
But yeah, we got to pour one out for Calvasina. That's I don't know. It's a very touching story. I also didn't realize that there were other Shiba Inos that have also gotten meme-ified.
Yes. There's a lot of fame. They are the superstars of the dog world right now.
So, do you have a dog at all?
I do, but she's kind of a mix. She's
and she can't be a meme.
I don't know. I take enough pictures, so yeah, maybe.
Got to get her own Instagram account.
Exactly.
TikTok.
Exactly. All right, let's take a look at how markets closed on the day, the Friday before a long weekend. It was a big yawn, certainly in the bond space, because the bond market closed early, 2 p.m. closing time. You could see the yield on the 2-year moving slightly higher. The S&P 500, up 0.7%. Not a record high there, but for the NASDAQ 100 and NASDAQ Composite, it was.
Yeah. All right. Well, we close out the week, and now we head into a holiday shortened week here, so maybe not a whole lot of action up ahead.
Jobs. We have jobs next week.
Jobs day, a week from Friday. So maybe we have to wait to Friday and get a bit of a pop. All right, we'll be back in a moment. This is The Close on Bloomberg.
Vice President Kamala Harris is gaining popularity in some key states. The latest Bloomberg Morning Consult poll found that 48% of swing state voters say they trust Harris to step in for President Biden if he can no longer serve. This is the highest reading since the survey was first conducted in October. So joining us now from Washington is Bloomberg Balance of Power co-host Joe Mathieu with more. So Joe, it's one thing to say that people trust her to step in if President Biden can't serve out his term, but on their own, would people want her to step in out of all the possible Democratic stars?
That remains a big question here. Obviously, Joe Biden is hoping to be the nominee at the convention, and that's not so much the thrust of what the campaign is thinking about here. This is the chief surrogate for Joe Biden at a time when he needs one badly and when he is losing ground with black voters and Hispanic voters whom the vice president can reach out to in a way that he simply cannot. And we saw a good example of that today as she spent time talking with the president of Kenya as part of his state visit here about some of the issues that the campaign wants to get into. She's also been dispatched on the issue of abortion. And this is something that Republicans think they can seize on as a mobilizing factor in this campaign to actually get progressives off the couch to vote for Joe Biden again. These roads lead to Kamala Harris. And when we see an uptick like this in the polls, Congress. The timing is not a coincidence.
I am curious. Well, it's interesting you mentioned the timing here, Joe, because I kind of feel like the Biden administration has kept her under wraps for the last 3 years. There's been a lot of hay made about some of the tasks, I guess, that the Biden administration gave her early in their tenure here, and I guess they didn't feel like it was up to snuff here. What is the relationship? Do you have any insight? What is the relationship between Kamala and Joe?
Look, they still have lunch reportedly once a week, and he has used his experience as a vice president to inform the relationship that he has now, because I don't think Joe Biden ever thought that he quite had the shake that he deserved in the Obama administration, and wanted to elevate Kamala Harris to something more than a president in waiting, so to speak. But I think you're also referring to a very difficult portfolio that she got early on, Romaine, starting with the border. Imagine of all issues for a Democrat to be saddled with here. So I think the issues that she's been addressing in public have evolved in a way that has helped her numbers as well.
All right, Joe Mathieu, the co-host of Bloomberg's Balance of Power. Joe will be back at the top of the hour with all your political coverage. Please stick for that. Meanwhile, here on The Close, we unfortunately do have to acknowledge a very grim anniversary, because tomorrow marks 4 years since the murder of George Floyd at the hands of Minneapolis police. It was a killing that shocked the nation. 9 minutes and 29 seconds. One of those police officers kept his knee on George Floyd's neck, and it looked to some observers like it could be a catalyst for real reforms here when it comes to wealth gap in the black community, when it comes to race relations overall. But our next guest says a Supreme Court decision this week over South Carolina's voting map is actually a big setback for racial equality, one of several. Janai Nelson joining us right now. She's the president and director counsel of the Legal Defense Fund. And Janai, I think after George Floyd's death, at least after we got through the shock and sadness of it all, there was sort of a tinge of optimism that something good would come out of this, that his death would not be in vain. When you look at the progress over the last 4 years, are you satisfied with what we achieved?
No, I'm definitely not satisfied. There's so much more work to be done, but I am encouraged. I think that the 2020 protests proved that there is still power in protest, that people can actually effect change when we come together in numbers across racial, generational, economic, and other lines, and make clear our dissatisfaction with the status quo. What we saw in 2020 was a galvanizing movement, and it actually did spur a new conversation about public safety. And we see that there have been some significant reforms in many states across the country. Yeah. We're far from where we need to be, though.
It's certainly galvan. I'm glad you used that word, because probably one of the more striking hallmarks, I think, of the protests that came out of this was just how diverse the group of people were out there, not just racially, but just across all types of demographics here. It probably was one of the more unified type of protests that we've seen in this country in quite some time. Yet there was also a great deal of pushback that came with that, Janai. And that pushback has led to a lot of consequences, including court decisions like the Supreme Court decision that we just referenced.
Absolutely. I mean, we saw pushback immediately. Since the 2020 George Floyd protest, the protest for racial justice and equity, we have seen over 100 anti-protest bills in this country. So there is a direct reflection of, I think, that the power that concerned many people. And the reason that there's been a pushback is because the protest really had the potential and still has the potential to do some significant work. But we saw in a Supreme Court case just yesterday that there are still many defects in our system, and our court system in particular. The Supreme Court is extraordinarily compromised in this moment. We were litigating a case that was about a clear racial gerrymander in the state of South Carolina. We won before 3 judges at the lower court level, but when it got to the Supreme Court, there was a 6-3 majority that ruled against us, and it was clearly along political lines. And it's extremely concerning when you cannot use the political process for change, then you must resort to protest. And that's where the court is leaving us.
Janai, I also wonder how you think about the linkage to the state of the economy, because summer 2020, as reminded us, there was a lot of optimism that companies would follow through on their promises to reform their workplaces. And we know they earmarked a lot of money for racial justice initiatives. But That was during a very tight labor market in which employees had a lot of leverage and employers wanted to hold on to their talent. Now that there's a lot of talk about the economy slowing down, the job market no longer being so secure for workers, DEI programs and these racial justice initiatives become a very easy place for companies to cut costs.
It's true. And we have seen some companies capitulate even when they don't have to. And it's actually a bad business decision to move away from DEI. All the research shows that when you have diverse teams, when you leverage the greatest strength of this country, which is our diversity, productivity goes up, innovation goes up, profits go up. So the idea that in an economic pinch that you would cut DEI is actually a bad business decision. It may be counterintuitive to some, but it actually is an investment in the future of our economy to ensure that we invest in DEIA.
Janai, I got to ask you, what is your single biggest worry when it comes to the election in November?
Mis and disinformation. I think that voters are engaged, but it is definitely difficult to comb through some of the mixed messages. But I say use us as a trusted source, naacpldf.org. We have information, we're nonpartisan, and all we care about is ensuring that voters can cast a ballot that will be counted.
All right, Janai, gonna have to leave it there. Appreciate you taking time for us. Janai Nelson, President and Director Counsel of the Legal Defense Fund. And just a quick programming note here. Our Bloomberg Equality special programming is back this year. We do this every June. This June, on every Thursday at 12 p.m. New York time, we will have special coverage of some of the broader issues affecting equality across this nation and, quite frankly, across the world. All right, meanwhile, here on The Close, we are going to set you up for a holiday shortened week and what to keep your eyes on in the week ahead. This is Bloomberg. All right, as we wrap up a relatively busy week, we push ahead to, well, what could be another busy week, but it will be a holiday shortened week, Scarlett Fu.
Yes, Monday's Memorial Day, so everyone's going to be barbecuing. I'm going to be watching lots of sporting events. The Rangers are playing in the playoffs, of course, and the LA Dodgers are in town. So Shohei Ohtani is in the world's biggest media market.
All right, well, there you have it. We all know Scarlett Fu's plans. We know where to find her. Meanwhile, when we come back to work on Tuesday, we are going to get some economic data that could move the market.
Yeah, consumer confidence numbers from the Conference Board. This is really interesting, of course, because the U-Michigan numbers that came out today showed consumers are a little more confident than economists had anticipated, and their inflation expectations have come down,
and
too.
That's key, right?
Yes.
Absolutely. And we got some big elections going on overseas, particularly in South Africa. This could be a big one, depending on how it shakes out.
Absolutely. And we'll be all over that. So watch Bloomberg for special coverage of the South Africa election.
And guess what, Scarlett Fu? Inflation, earnings.
Yes.
Earnings never stops. And we get more next week, including from a lot of big retailers. One that I'm keeping an eye on is Nordstrom.
Yes, Nordstrom, of course, with questions over whether the family is going to take the company private or not. The other big question here is Gap, because it's in a turnaround mode, and whether the new CEO can deliver. And Dell is the newest AI play.
Yeah, Dell, I find all these interesting. Well, not Costco, but Nordstrom, Gap.
I love Costco.
And then Best Buy, too, also going through some issues.
Yes.
And then, of course, Dell, which I don't know. I mean,
the AI servers.
I know. Is this going to be like the comeback for Dell?
It may just be, yeah. It's a hardware company, and it makes exactly what people are looking for right now. You just mentioned that you're not excited about Costco, but that's why it's such an appealing stock, because it just delivers every single time. It's like super stable.
All right.
I like shopping at Costco.
We'll have full coverage. We'll have full coverage of Costco next week. We also get another big report on inflation, the one that Jay Powell likes, PCE data.
Yeah, that's right. And I was looking at the numbers. 2.8% year over year for core PCE deflator, 0.2% month over month.
All right. Thanks for joining us this week here on The Close. You can catch Scarlett either at Costco or watching Shohei Ohtani, Balance of Power, up next, right here on Bloomberg.